We're here for Data Day. We've got the man Dean, we've got Jeff. We're gonna get it. Good morning, gents. How you guys doing this morning?
Good.
Great.
Good,
Great to be
man.
with
Can't
you.
wait to do this. It's always a
Great.
fun time with Dean. So let's go
Mhm.
and do this.
To the HPLS podcast. Live, relevant, and high performance information, conversations, and education weekly.
Love that. I felt like Jeff and we should have been wearing our Christmas sweaters today. It's loving to see Dean. And
I know.
before we actually get started, I actually want to shout out yesterday's Data IQ show. It was amazing to see Jason Miller on there from, I believe it's Michigan State. I think he's the professor at.
Yep.
And just the knowledge that he has. So if you didn't check
Mm.
it out, even if he's like one of like the most followed, like you should follow him on LinkedIn if you're not
Right.
if you're in logistics, right? But
Yeah.
Dean, you want to run down a little bit what you guys kind of talked about yesterday?
Yeah. He's at the start of the show. We were talking about LinkedIn because I kind of pump up his tires everywhere I go, and every time I speak, I recommend people follow him because he's one of the best data analysts I've seen in the logistics industry. Of course, he teaches it at Michigan State University. I think he's the head of their supply chain. I can't remember the exact name of the part of the faculty that he's in, but he says he picks up about 1,000 LinkedIn followers a month, which is kind of amazing. He's got an incredible following. And for good reason, because over the course of the pandemic, he's been the one guy that's been able to make sense of the macroeconomic conditions. And as a result of that, because I asked him about data sets. I said, you talk about data sets that I've never thought about. And he said, well, I've been forced to try and find reasons to tell the story around what's happening. So he's been, along with us, he's been learning about new data sets to the point where he's changed his curriculum and adding in new data sets as part of his training course for upcoming logistics professionals at his college. So and as a result, he developed the Michigan State University Truckload Ton Mile Index. The acronym is TTMI. And so he developed that in the last couple of years to try and fix, because he was really disappointed, I think, in how some of the other major indices were tracking truckload demand during the pandemic. You might remember that one popular truckload index said that truckload volumes were up 52% just after the global demand crashed. And everybody said, hold on, what? That can't be right. Maybe retail demand was up 52%, but truckload demand not so. So he developed his own index, and as a result, it tracks very similarly with ATA truckload tonnage, CAS index that Tim DeNoyer writes and measures the data on. He's the VP at ACT Research. And so the TTMI is very interesting. He's pulled data from 41 freight producing commodities to track truckload ton miles. It's proved to be a really good data set. So that's just one of the things he's been able to do to keep us informed of the market. But I'm just staggered at his breadth of knowledge across the entire supply chain. He's just such a clever guy, very personable guy, very approachable, easy to contact. I'd encourage everyone to follow Jason Miller on LinkedIn and watch yesterday's show. I'm glad you watched it, Ryan. But yesterday's show was particularly good. We went pretty long. We probably had a good solid half an hour with Jason. We could talk a lot longer with this guy, but so that's kind of that was yesterday's show. We always wrap up the year with him. We had Tim DeNoyer on the week before, who was talking more macroeconomics. So it's a good way to end the year because we're still headed for somewhat uncertain times, I think, given all of the things that are going on globally. But I do think our supply chains are certainly getting back to normal, which was one thing he touched on yesterday. There's a lot more normality coming back into our market, although we're heading for a rather, I think, a much slower demand. He sort of echoed some of the thoughts we've had on this show, and that is that Q1 demand will be much slower. He did say something, Ryan, that I thought was interesting. He said his ton mile index, he thinks, will go negative year over year in November. Oh. And he said, I'll be surprised if it doesn't. And that's really interesting. So ATA truckload tonnage came out yesterday and said that volumes were down 2.5%. And of course, there's all the scary headlines from the media who are fairly misinformed on this subject, trucking media, that is. The volumes are still up 1% year over year on the truckload tonnage side. And if you look at the index at 115, it's the same as what it was thereabouts in December of the last few years, with the exception of last year where it was much higher. So it's not, so December, it's about where it was in pre-pandemic years is the point. So even though the headlines say truckload demand crashed, again, another misleading headline from the media, but that doesn't mean that we aren't headed for a quiet Q1, which is what we've been saying for a long time. Yep. So the truckload demand has certainly cooled off. I'm not surprised that it's cooled off as much as it has, given the peak demand we had both last year and in the middle of this year. So for all the data points that I look at, December looks fairly normal compared to pre-pandemic years, both in the spot market and the contract market. When we look at volumes, I think we'll end the year flat to maybe slightly down or up, give or take a few basis points here or there in terms of demand, which is good. I think that's a good place to end. Next year will be a different story because it'll be a year of two halves. It'll be the first year will be much slower, I think, and then the second half will pick up because that's when the next part of the freight cycle gets into its upswing. Right. The biggest story right now is, of course, we've got a lot of capacity in the market as a result of the record number of carriers that have entered the industry in the last 18 months. And unlike previous years, they haven't exited it at the same rate they did in 2019. And I think this is one thing Jason said yesterday that I thought was absolutely fascinating. And I'd forgotten this data point. He wrote about this during the 2019 period, because remember we had some big truckload carriers go bankrupt in 2019. Yep. We had New England Motor Freight, Celadon. Like there were some big names that went out. So if you think about the analogy of the rising tide lifts all boats, well, it's kind of the reverse in 2019, because the sinking tide kind of sunk everybody as demand fell away in 2019. So it affected all companies, big and small. The data point he shared with us that is different to this year, this is why he was adamant you can't compare freight cycles of recent times to what's going on today, because it is so extraordinarily different. He said 2019 was one of the weirdest years ever, incredibly high rate of exits of young firms. And he said 40% of companies in trucking companies that were started between March of 2018, right? And that's when the industrial economy really took off. We had economic stimulus, changes in the tax code, accelerated depreciation, and we had record numbers of truck orders come on at the end of the year. He said 40% of companies started between March of 18 and March of 19 were gone by the start of the pandemic, March 20. That's an extraordinarily high number, and we're not seeing anywhere near that now for a couple of reasons. Something we've been talking about forever, and that is for 18 months, carriers had a really good period of operating margin. Like their profits were extraordinary through 2021 and early on in this year. So they were coming off an extraordinarily profitable period. The other thing is there's more transparency in the market. You've got more data, more technology, more apps, you've got more visibility, you're more nimble, more dynamic pricing tools out there. And the other thing is there's a lot of carriers that have done really well and sold off some of their assets this year, been able to make money on that side. So they've had a lot more runway this year. But the other bigger point, and this sort of maybe Jeff's good segue to you on the shipper side, shippers have been able to systematically ship more volume to the spot market this year. So our spot market volumes are still pretty solid when we look at them. I mean, we're down compared to last year. Absolutely. When I look at load posts on our spot market load board, we're about where we were in the 4 years before the pandemic for December, right? So the volume going to the spot market is on par, but it's half what it was last year, because this time last year we were talking about all sorts of calamity. So the spot market is still pretty healthy, but what shippers are doing is rather than send all of their lanes to an RFP for you to quote on one load a year, right, for a carrier, which automatically sets yourself up for a service failure almost every time. So obviously that would be an acceptance or a rejection on that primary tender. They're saying, well, let's just send that low volume lane to the spot market and let our non-asset brokers do a better job at managing the cost of that, because we'll give them more visibility, et cetera, et cetera. So there are a few things that are happening this time around that are very different. But I was kind of just amazed at some of the insights Jason was able to give us. Of course, he started off talking about the housing market as one of the big things that will affect the industry next year. So, that was sort of a 10-minute intro to the show. Sorry, Ryan, but you asked me about Jason Miller. He's just such a wealth of knowledge.
Yeah, Dean, you brought up a good point. From the shipper's perspective, and I don't agree with it, and I have two reasons why. Yes, shippers are bouncing from the contractual side of the business to the spot market because they're trying to take advantage of the spot market rates.
Right.
What's going to happen with that? First of all, their corral of carriers that they have on board right now, they're taking revenue away from them and they're dropping it into the spot market. So now they're semi destroying the relationships that they have because the the asset based carriers that are out there are trying to get by and they need this revenue. So they're going to remember shippers in the long run when the shippers go back to them and say, "Hey, I need you to come back in."
Right,
you know what they're going to say, right?
Yeah.
So they're going to get screwed in the long run. You got to feed these carriers. You got to keep them moving. You have to be complacent with them. You have to show them that you're a true partner by taking that revenue away from them and going to the spot market. Sure, it's going to decrease your cost in a very short period of time, but you and I both know that's going to change. Spot market is still coming down. The contractual rates, believe it or not, from what I've seen, are still up there. Some are being pulled down, but some of them, there's a huge difference between the two. RFPs, very short term right now because it's not sustainable. When you go to the spot market, you get these outrageous rates. If you think they're going to be in place on a contractual relationship for a year, it's not going to happen. You're talking about maybe 2 to 3 months tops, especially in the first quarter coming up. Rates are still going to be low. And like you said, Dean, as we start getting into spring, summer, back into peak season, those rates are going to, they're going to skyrocket and get back on course. But it's not a very good idea for these shippers to start going to the spot market and, trying to save as much money because it's going to hurt them in the long run.
It accelerates the timeline to the next cycle, right? Because if you force capacity out of the market, then it obviously just brings forward when we think spot rates will bottom. I was just looking at some of our long-term forecasts from yesterday. Our rate cast has got rates by the time we get to early January. So remember, this time at the start of this year, rates were still elevated going into January, and then they dropped down sort of middle of January. We've got rates at about, line haul rates excluding fuel, at about $1.80, which is where they are now. So excluding fuel, about on the dry van side. So that's kind of where we think rates are going to land. Where they go from there, though, is the bigger question: how much lower? And the reason I mentioned that, Jeff, we talked about this on the show yesterday. With diesel coming down another, I think it was 15 cents this week. It's down 97 cents a gallon since the high on July 11. That drop in diesel has brought my operating costs down on a long haul truck by about 16 cents a mile. So I'm getting some relief there. My operating costs, if the truck that we've been talking about for the last couple of years that runs 100,000 loaded, 15,000 empty, financed, you've got a finance truck, pretty good insurance rating. So it's a middle of the road type owner operator truck. Operating costs have come down from $2.12 a mile, which is what they were in July when diesel was well over $5, down to about $1.96 today. Now, remember, I'm paying the driver 61 cents a mile. Fuel is 71 cents a mile. So I've still got fairly high costs, but my costs are down about $1.96. Line haul rates at $1.80. I'm not far off where I could go lower on some lanes and higher on others because DAT's top 50 lanes are running at $2.10 a mile on average. It's where most of our volume moves. So if I'm picking lanes where there's a higher than the national average, I can get by at the moment. So I don't see all the doom and gloom for the average carrier. Now, of course, you would say there's no one there at the average because it's all about the extremes. And that's a true statement because at the extremes, there's carriers that have no finance costs. They own their truck and trailers, plural, so they can interchange between different modes and pick up different lanes and commodity types. They could run for $1.70 without any problem. They can't do it for long because they're going to eat away their equity. But on the high side, if you're a new carrier that's come in and paid $140,000 for a truck that's out of warranty with 500,000 miles on it, and you've got a new entrant insurance costs of somewhere between 25 and 30,000 per powered unit, you're going to really struggle if you're not getting all of that fuel recapture program. Like if you're not getting the fuel surcharge on top of the line haul rate, you are really going to struggle. And I think that's where we hear some carriers say, I can't sustain what I'm doing right now. And so there's going to be carriers that unfortunately are going to, sell their trucks and get out of the industry. Used prices are still pretty healthy. So it's not all bad. I guess it isn't that good if you paid a lot more for the truck than it's worth now. I get that. But that's sort of where we are in the market right now. Is it's a really bifurcated market in terms of where carriers can operate at, unlike previous years where it kind of affected everybody, largely because demand is still pretty solid. Like demand is still pretty good compared to this time last year. I just don't buy into all the headlines that come out. People are looking for, it's almost clickbait headlines trying to drive a market narrative that just doesn't make sense. And that brings us back to Jason Miller, who has been the guy that's really given us some good insights in the last 18 months. And I think he's been absolutely spot on in most of his analyses of the market. So I just, again, everybody should be following him and listening to him and catch that show yesterday.
Yeah, and Dean, I kind of want to get your opinion on this, because last week we pre-recorded an episode that's showing tomorrow with Jeb Blunt, and he doesn't know any. He's a sales professional, but an author and different things. He doesn't work in the logistics industry, and he was actually telling us that in the next 3 months, you should not look at the mom and pop carriers, look at the regional and look at the national carriers to build relationships there, because he was seeing from his end, and he's somebody who's not in the industry as well, and he kind of dazzled both Jeff Dan and I with that knowledge. So it feels like anybody, if you were even to like study it a bit, you can kind of see it coming. So it's like you got to kind of prepare for that, right?
This is the opportunity. Jeff talked about this a year ago, right? Building relationships and partnerships. Oh, definitely. When the capacity was tight, that was the time to be doing it. I would say, if it depends on the volume, right, as to what carrier you look at regionally, because there's a lot of carriers that have been able to build very good businesses in the last 18 months around very small volume shippers who move only one load a week on a particular lane. So I think I wouldn't ignore the smaller carrier, because what you're looking for is that carrier that runs back to a particular location where no one else wants to run to, but he has a shipper in that town where he loads out of every week. So I think that's where you can see. I know some guys that have built really good businesses in the last year about that. Contract on one way and spot on the other. They built very good margins into their business by building good relationships with their shippers. And I think shippers are very much open to that right now. At least I hope they are.
Definitely. But unfortunately, there's a lot of shippers that really don't know the word collaboration. I mean, it's a fact. I'm gonna take. It's really funny. So I'm a broker, but I'm a different type of broker, because I don't go for the transactional. I'm a volume broker. Right. So I'm going to put my shipper's hat on, and this will not make sense for brokers. But if I was a shipper right now, I wouldn't go to the spot market. What I would be doing is that I would be talking to my carriers, my asset-based carriers that I deal with directly, and I would sit them down at the table, and I would have that come to Jesus type meeting and saying, hey, listen, you and I both know the spot market is diving. Okay, it's pulling some of the contractual business, but I'm hurting inside. Okay, I want to work with you. I want to keep on feeding you. I want to try to build this relationship much more. This is what's happening in the future. This is what we're working on right now. This is when we're going to start ramping up things. Let's talk. What can I do for you, and what can you do for me? Those are the type of conversations that you need to have. Because those guys, if the carriers are hurting, well, guess what? The shippers are hurting too. So you have to have that kind of collaboration where you can agree to disagree, because that's what long-term business relationships, really good ones, are built on, because they see your point of view and you see theirs. Very, very, very important. So that's what brokers are up against right now. The smart shippers that are out there are doing exactly this right now on the big hitters. I'm talking like the Fortune 100. I'm talking the ones that move like thousands and thousands of loads every single year. This is ideal for them to do that right now.
Right. Yeah. All right. So Yeah. So what's you want to sort of just recap this year from a data perspective?
Yeah,
Yeah.
I'd love to the difference kind of like truckload and
Yeah.
spot maybe year over year review, what we've kind of seen. And yeah, let's give some some
Yeah.
data points and maybe we kind of finish it off with some
So
maybe some tips for next year.
okay. So if I just talk dry van, flatbed and reefer have been, pretty tumultuous years for a number of reasons, produce and housing industry sort of demand falling away respectively. But in the dry van side, um, volumes are about half where they were this time last year. I'll give you some comparisons because I think the best way to put this into perspective is to use some prior years where there was reasonable normality. The load post volumes in our dry van market are identical within like 1,000 loads of December 19. So not a strong year for truckload, right? 19, we were still shedding capacity in December 19. The market was still sliding south until the pandemic hit. When you look at the FMCSA carrier authorizations, we were still losing capacity in January, February before the pandemic was declared. So I don't know what 2020 would have looked like without the pandemic, but it would have been a pretty bad year for everybody after what looked like a disastrous 2019. So that's where we sit from a load post perspective. By all accounts, we're looking at something like 90% of the loads are still moving under contract and about 10% are moving under spot. I think that could even be more contract. It could be closer to 95.5. Again, contract rates are still pretty high, as Jeff mentioned. They are stubbornly high, but they are the long-term rates are coming down slowly. Our experts over at MIT, Professor Kaplis, who's also a chief data scientist, are forecasting the low point in contract rates will be sometime late Q1, early Q2. So that's when we sort of see the market inflection. We see the same in our forecasts. So that's where volumes sit. But I think when you think about the spot market that leads contract rates on a 4 to 6 month lag, the biggest story right now in terms of rate pressure, downward rate pressure, is the number of trucks that are looking for loads, and that far outweighs the number of spot market loads. So if load posts in the spot market are identical to December 2019, the number of carriers posting their trucks on our load boards looking for work, which is a proxy for capacity, is 30% higher than December 2019. So broader context, 2019 was not a great year for trucking. Demand, if you think about spot market demand, is about the same as December 2019, but 30% more trucks is why spot rates are still got downward pressure on them. Now, in some senses, we think that the rates have certainly bottomed out for this year, right? So they're bottomed out at about $1.80, $1.82 a mile. They will go up until the middle of January and then come back down again. So I think there's a floor to where rates can go to. I don't know you can go much lower than that because of all the higher operating costs that we've already been talking about. It's the same with contract carriers, Jeff, because, and Ryan, they've got a lot higher operating costs right now, and they are thinking about the next cycle. That's why they're ordering trucks that have got a 9-month lead time. They know they need to keep their drivers. They can't take away the record high pay increases they've given them. They're thinking about the second half of 2023, and they see a pretty strong market. So that's sort of where we sit at the end of 2023. Refrigerated is a little bit worse story because it's been damaged by the produce season, to a degree. We're in the quiet period, of course, but volumes are down about 15% year over year in the produce market. But we are seeing a lot more come across the southern border. So I think those that are in the non-asset space that are thinking about where is the, what happens next year with produce season, I think we'll see a lot more volume across the southern border, as we will for a lot of other goods that are being nearshored to Mexico. Flatbed, on the other hand, flatbed is a real, it's been a disaster for carriers. It started off identical to 2018, which was a good year that was primarily a flatbed-driven rate rally. But the second half has looked absolutely terrible. If I look at the load posts in flatbed, we are 9% below where we were in 2018, right? And about 22% lower than 2019. So not so good at the end of the year. Again, this is the quiet time of the year for flatbed. So, we shouldn't be reading too much into the numbers other than there is seasonality, but it is lower. So the demand has fallen right away. The biggest story, though, is the number of trucks posting their loads for work on our load boards in the flatbed space, 60% higher than the number of flatbeds posting their trucks on our load board in 2019. So a lot of capacity in flatbed, and that's why those rates have, really struggled this year to make up some ground. Flatbed rates are down 90 cents a mile, 63 cents a mile year to date. But all of that has happened since June 1.
Yeah.
So it's been a tale of 2 years in flatbed. And Jason Miller, coming back to where he started the show yesterday, he said the biggest thing he's looking at is the single family housing market. And he said because volumes are way down, he said we've seen single family housing fully regress to where it was in 2018 and 2019 when you look at the number of homes. But what he said is it not only affects flatbed carriers moving housing products like lumber and shingles, but it also affects large appliance manufacturers' production, right, which connects to warehouses and demand for steel that's used in appliances. There's a lot of dry van volume that moves a lot of that material around that get used in finishing houses. So the housing market is going to affect a lot. And he also said that there's a lot of that comes in from overseas. And that's going to, so when the imports fall away, that's going to also impact the flatbed and dry van market as it relates to goods that come in for things like furniture, which has always been the biggest commodity we've imported. So that's kind of where we sit at the end of the year in the spot market. Where we go from here is going to be a interesting story. We've got signs that interest rates are, obviously still high, but inflation is easing. I don't know whether we're at the peak. Jason Miller did say something yesterday that I thought was interesting. He's almost sure we had a freight recession in Q3. It's a very interesting statement, if not in Q4. So we don't always see a broader economic recession and a freight recession at the same time. You can have either at the same time. So how we end this quarter will be very interesting. It may well be the case that we end Q4 technically in a freight recession when you look at some of the metrics that he's tracking. So big start to the year, pretty disappointing finish, big middle.
Just like the Maple Leafs, they start well and then they taper off. But I do want to touch on the flatbed thing because, Dean, I was a flatbed guy, and in 2019, I did a lot of event logistics. So I did a lot of Cirque du Soleil, and half of it would be flatbed moves, and we would go to the spot market for it. And so 2019 was big for me personally in the flatbed market. Every other month we would have a show, but then the pandemic happened, and then we literally went from event a couple shows to nothing. To zero. But when we did come back, I don't know if it was the company itself, but they transitioned. Instead of picking dry vans and flatbeds, they just own the trailers and they just getting power onlys, moving it from city to city. So they've completely stopped. I'll be completely transparent with you. I haven't done any shows since prior to the pandemic because they've changed that. So that's a sector there, and you look at it, right? There's certain events always kind of going on, and I was specifically doing for Cirque du Soleil and a Jurassic Park show for Feld Entertainment. So when you think of that section, right, and in terms of flatbed, because when I used to dispatch flatbed, I did insulation, shingles, anything to do with housing that goes year round. That was all me. But that was very interesting for me to go okay, we're killing it in 2018-19 with the events, and then literally nothing.
Nothing. Yep, I think flatbeds. We had a conversation with a big flatbeds carrier of ours this week, and they said something really interesting. We were talking about how they see demand, and they said, yeah, we agree that things are going to be pretty difficult between now and March. But when we look at and they were pinning a lot of their demand forecasts on the infrastructure bill spending, freight moving in the March timeframe. And the reason they said March, when they went back and looked at the last infrastructure bill and when the freight demand peaked for them, it was in March. And I can't remember what year it was they were talking about, but they were saying that the timing of it, by the time the money trickles through and people start building and moving and planning and developing different infrastructure sites, that's when we thought volume would pick up. Now, of course, March is when flatbed volumes pick up anyway, especially in the northern half of the country. That's when steel volumes peak. That's when machinery imports peak for planting season. So I think for flatbed carriers, if you can get through to March, that will be you'll be fine in terms of how next year looks like. Between now and March, though, things are going to be fairly difficult for those flatbed carriers.
Yeah. one of the things that what I'm doing with my customers right now, and I talk about the RFP because it's very, very important, especially right now going into the first quarter. What I'm telling my carriers and my customers is that, listen, we're looking at short-term rates right now. I'm going to be monitoring the market. If there's a drastic change in fuel or rates, we're going to have another conversation about that because, again, it's all about collaboration. If the driver and the carrier needs more money, well, you're going to have to pay, and how am I able to do that? Excellent service above anything else and feeding and exceeding the customer's needs. So that's what I'm doing. So I'm doing the short-term RFP with the consideration of revisiting those rates at specific times if there's a drastic change, and that keeps it going. That means, and vice versa too, Dean and Ryan. I mean, if rates start dropping, we have that same conversation. It's all about collaborations. It's the things that they don't want to hear and what they do want to hear, but you have to bring everybody together to, go down that same path. And if you don't talk about these things, you're going to be left high and dry. So it's very important to do that. You can, in a down market, change those rates and be able to adjust them accordingly as the market changes if you want to go that direction.
Yeah, it's an interesting market. We were talking yesterday with Jason about this market cycle, and I was and he made this statement. And again, this is based on the 2017 survey data that he gets from the Bureau of Transport and Statistics. He took a swag at the number of truckloads in the trucking industry at about 225 million over the course of a year, which is about, I think he said it was about 1 million a week. Was it about 1 million a week or a day? Can't remember. 225 million a year. My math is absolutely blows, even though I've got a massive calculator. I loved your post yesterday, Jeff. Solar. Jeff, look at that. Yeah, I love the old school calculator and notepad.
Show us your calculators.
Solar. So he said there's about 225 million, and 225, 123, divide 52 weeks is 500,000 a week. So that doesn't sound right. Anyway, so anyway, a lot of loads. The point is that about 75% of those loads move under 100 miles. So when you talk about the trucking industry, it's only like something 4 to 5% move over 1,000 miles. It's not a lot of loads in totality that moves. So when people talk about, doom and gloom in the trucking industry, we are talking about the margins in the spot market where carriers come and go out of the business because there's opportunity. With opportunity in the spot market comes volatility. Sometimes things don't work out and you've got to, reposition. And I was thinking about the health of the industry, and most of the guys I know are still putting stainless steel visors on. They're still, going to truck shows. They're still doing really, really well because they're not in the spot market. It's contractual work. They're hauling loam, asphalt. They're paving still. They're hauling, sod. They're still laying sod out on Long Island. Yeah, I got a friend of mine just dropped his car trailer. He normally runs Florida, and he's running a flatbed with sod, new lawn out to Montauk. They're still laying lawn in Montauk in December. Anyway, so there's a lot of guys out there. The majority of truckers in the industry are doing really, really well because they're not in the spot market. So I think we kind of lose that perspective when you follow the media and they talk about the trucking industry. You're talking about carriers in the margins of the industry. When you talk about long haul trucking in the spot market, it's primarily when you get into those loads over 250 miles plus that the spot market starts to have a play. That's not where the majority of trucks are. So I always think the industry is very healthy because when I hear the negative stories, I think back to everybody I know in the trucking industry that's doing really, really well. Sure, rates aren't as good as what they were, but they've still got good relationships with their customers. They've still got good contract work. They've got great relationships with their brokers and or shippers. So that's sort of where I'd leave 2022 and sort of to put it into context that the industry is still fairly healthy. That said, we've all had a pretty hard year. We've been beaten up on operating costs. We still can't find, mechanics. A lot of us still can't find, the right drivers, the right mix. I saw something, an Instagram post, or actually it was a TikTok post with Mike Rowe, and he was talking about he said something like the number escapes about how many million working class men are still out of the workforce. And it kind of and again I should remember the number because it kind of struck me. And he wasn't politicizing this, but he was saying that it has been politicized because on one side people are saying they're just lazy, et cetera, et cetera. On the other side, they're saying, hey, wages need to be better, right? And I think there's probably a bit of truth in some of that. But if you just think about the numbers, right, the pandemic has forced a lot of people out of the industry. A lot of people are retired. A lot of people have changed their home life priorities. So and they've changed jobs and skills, like they've reskilled in the pandemic. So I think there's been a really long-term change in the workforce that's meant it's hard to find people. That's why you've still got so many job openings in the market. And that was really Mike Rowe's point about the job market. There's still a lot of job openings out there, but there's far fewer people looking for work, actively looking for work this time of the year. And then, of course, the backdrop of that is you've got all these mass layoffs in technology companies. What a terrible time of the year to be laid off. I mean, it's bad any time of the year having experienced it, but right before Christmas, that's as callous and shallow as you get to terminate people like that. So, whilst we talk about
look at that one company. I think it was in Alabama, the
furniture company.
Yep. Right before Thanksgiving. No indication, and everybody got an email that said they're done. I mean,
was it at midnight? Yeah, while they were sleeping, I think was the headline we read. That was just that's terrible. I don't know how you do that.
It's just unbelievable how people, and even look, some brokerages too. I mean, you read it as well as I. You know how many people they put on furlough and let them go, and and you look at, unfortunately, the no solicitation, the non-competes that they had, putting these people in a really bad situation where they can't do anything, and then they have to fight to get their career back. And recession, I mean, they don't have the money to go and do that. I mean, what do you do in those type of situations? So it's bad all the way around on that. It's not one place, it's many.
Right. I was just thinking about some other data points I had to share.
What were the data sets that Mr.
Jason?
Miller, going on? You said that there were a few. I missed it. I apologize. I missed it yesterday. I had a lot of things that I was working on. I wanted to, but what are those new data sets that he was looking into for the people that haven't seen it, even myself yesterday?
Yeah, I mean, the big one he watches that as it related to the freight market was the Census Bureau data. So he looks at that data point. The data point that got everyone's attention this week that was new was the inventory levels. And the inventory levels, I'm trying to look at the data point here on the chart right now. It was on his LinkedIn post from a couple of days ago. October. If I
so what was he looking specifically like at FMD forecast monthly demands?
He's looking at general. Well, he was looking at general merchandise retail sector NAICS 4529 or 4523. So he was pulling this from, and if I click on this link, will it take me there? I'm quickly scanning here to see where he gets this data from. Does he have a source underneath? No. So he was looking at the data that I can't remember the exact. I think this is a FRED database. The database, the FRED database, and he's looking at the seasonally adjusted days to turn inventory for some of the big shippers. And that was a data point that he used to extrapolate what was happening with retail inventories, and that sort of led to some of those comments. That was one. I think the FRED database has got a lot of hidden gems in there, even though it's a little bit lagged. That's where he pulls a lot of really good data from, in addition to building his own metrics. And then, of course, the other one he referenced was the US Census Bureau that pushed out their single-family housing starts and building permit applications yesterday. The November data was out yesterday. It always comes out around the 15th of each month. But it's an important one for a lot of us, for not just dry van, but also for flatbed carriers, because permit applications tend to lead housing starts by a few months. So if you wanted to know what flatbed demand looks like, you can look at how many permits are being applied for houses that will start. I look at single family housing more so because they are generally more flatbed intensive. If you're talking about housing demand for flatbed carriers, that was one of those data points that we looked at. And I'm just quickly scanning through my notes from yesterday. EIN numbers are another one he looks at, which are the number, that's the business application EIN request. He looks at those numbers to get a measure of how many companies are coming and going. That one's a little bit more lagged because I think it's quarterly. I think his data is quarterly on that one. The commodity flow survey is the other big one that he uses, but it's only done every 4 years. The Bureau of Transport Statistics does the commodity flow survey. I think it could be out early next year for the 2021 year or the 4 years preceding 2021. So that was that one. And I'm quickly looking, that probably wrapped it up. I think there wasn't anything else.
But you think about it, it's the trickle down effect, as I would call it, because when you look at vertical specifics, right, in whatever it may be, that information, I have a term I've always used in many decades, is that I believe in God, everybody else brings data, right? Because you can't make decisions emotionally. You've got to remove that part of it, right? Because if you're going to drive a business forward profitably, you have to have really good data sets, right? I know I agree with that wholeheartedly. The thing is that on the forecast monthly demand in certain verticals, or I would say in all verticals, is going to lead to pressure, demand increases, whatever. So that's like the buyers, the consumer, what are their trends? How much are they buying? What are they buying? And how does that lead to? Because you talk about the vendors and the manufacturers, right? They have to create, they have to ship, they have to store, they have to ship, right? And so that tells you a story of what's going to happen predictably. What Jason Miller was looking at with all those different things. It's telling you that something's happening in the market. Be prepared. This is when it's going to happen. It's predictability.
Right.
I mean, that's good data gives you.
Well, he's got a great post out today on employment numbers. One of the data sets he uses is from the Bureau of Labor Statistics, the BLS. It's the CES data, which stands for Current Employment Statistics. So again, another data set. Bureau of Labor Statistics got some really good data. You can break down trucking, warehousing, and look at some of those data points. Good post today. He says that be aware that we could be overestimating trucking payrolls. For one reason or another. Time will tell if that's the case. He also thought yesterday on our show that the industry could be overestimating, because of this point here, overestimating payrolls. It's a component in some of the calculations they use for industrial production. I'm not sure how. He thought we might be overstating industrial production numbers also, which is a really important data point to follow. Again, Jason Miller will keep us up to date on that, but the reason that's important is and again, according to Jason, about 63% of ton miles in trucking come from industrial production. So we've got to watch industrial production is probably the more important number I watch for demand as a backup to what some of the other industry indices are pushing out.
Right. And of course, with the seasonality and things that are starting to come down, and as we start getting towards the spring, especially light furniture, outdoor material, whatever you need, that's going to start booming up. I mean, it's that vicious circle that we go through every single year. You still there? I think.
I think Dean's looking up. We're going to wrap up here. So want to thank everybody for coming out this morning. We had an amazing episode with Dean. We'll see you guys tomorrow for Wins and Lessons. And tune in again at 12 and 3 p.m. Eastern time. And we're looking forward to seeing you guys. As we said, Wins and Lessons on Friday. Tomorrow is going to be Jeb Blunt, pre-recorded lessons. So thank you, Jeff. You guys crushed it.